Good morning, students. Today we are going to see joint life policy in partnership. What is a life policy and why is it required, and what is sum assured, what is a surrender value, and what is maturity amount and accounting treatment of JLP in partnership, etc. What is a life policy? Let me take an example to make you understand. There is a family of 4, husband, wife, and 2 children. They have taken a house loan, and the husband is the only earning member of the family. And they have constructed a house, beautiful house, and staying there comfortably. After some time, all of a sudden, the husband, earning member of the family, dies due to some accident or illness or whatsoever the reason, natural calamity, anything may be there. So the husband dies, the survivor of the family, now unable to pay back the loan, and they may have to sell the house. So they are under financial crisis. In order to cover such risks, life policy is taken. Okay, life policy is always taken for a certain period because life is mortal. So they'll be taking it, let us take in this example, for 20 years. Okay, so this policy is taken by X. Let us take this fellow X. My drawing may not be so good. Please don't go for that. So this person X is taking a policy for 20 years with the insurance company for a value of, let us say, 10 lakh rupee. This value is decided by the insurance company and the policy holder, depending upon the paying capacity of premium. In order to take this policy, this fellow has to pay a premium every year. Let us say rupees 10,000 per year. So this is depending upon his paying capacity. The value of the policy is decided. Clear? So in case before the tenure, completion of the tenure, this fellow dies. So let us say like this. This is for 29th year. So this fellow, okay, dies. So he is cremated here. Okay, this is the fire. He is cremated. Then what happens? The insurance company will pay to the survivor 10 lakh rupee. This is the amount known as sum assured. Sure shot, they will get rupees 10 lakh. There is no need to pay the premium for the further period. Okay, so this is known as sum assured. What is a surrender value? There may be cases that this fellow pays the premium up to 4th year, and during 5th year, before he is making payment, he fell ill or he may be met with an accident. So here he is getting, his arm is up, he is not able to bring it down. Okay, so he is paralytical, his condition has become worse, so he is unable to, he has got a paralytic attack and he is not able to continue his service. Under such circumstances, he is not able to make the payment of premium from the 5th year. So what happens then? Then the insurance company, depending on the amount paid up to 4 years, they may pay him 70 or 80% of the value. That is known as surrender value. In case of partnership, in case of a partner retires, leaves the firm, he may get a surrender value after surrendering his policy. And what is a maturity amount? Maturity amount is, it may happen that he survives till the end of the tenure. After completion of 20 years, the insurance company will make a payment to the individual who is alive himself. So he will receive the payment because he has made the payment of premium. So that amount is known as maturity amount. So now we will see how this affects in partnership. Okay. So let us understand through a balance sheet of two partners. Let me take the balance sheet of X and Y. X has contributed a capital of 25 lakh. This is in lakhs, rupees in lakhs. This is the liability of this balance sheet, and asset is here. Okay, Y's capital is 25 lakh. So they have got a machinery for 50 lakhs. Suppose they are running a textile industry and they have got a machinery of 50 lakhs with this capital contributed. So their balance sheet looks like this. There is no cash, no bank amount, nothing is there. Okay. So under such circumstances, suppose Y dies. Y expires. So when he expires, his wife may come to X. Mrs. Y will come to X. What will happen? She will demand the capital contributed by her husband, that is 25 lakh. Now this fellow is not having any cash or bank in his business, so he may have to sell his machinery. If you sell a machinery after purchasing, you will not get the amount what you have paid on purchasing the machine. So now here let us assume that he has sold the machine for 40 lakhs. What will happen? He will receive cash. What is the journal entry? Cash or bank account will be 40 lakh. Okay. So that is a loss of 10 lakh. This will go to your P&L to machinery. So machinery has gone out for the value of 50 lakh. Now out of this 40 lakh, he will be making payment to Y's wife, executed 25 lakh. And now he is forced to close down his business. See here, the family of Y is suffering financial crisis because the fellow has died. But here in the case of X, he has not died, still he is suffering a financial crisis. Just he is forced to close down his business because there is no policy or some things that he has to sell his machinery. Now let us take this case that they are going for a policy. So here, before going to that, let us understand what is a joint policy. What is a joint life policy? Suppose this partners X and Y is there and a policy is taken in one name. That is joint life policy. So the premium is paid by the firm. Firm is the business. That is collectively the partners are known as the firm. The premium is paid by the firm, the business. Then what will happen? In case of Y dies, the insurance company will make payment to the firm. The business will receive the money. When the business is receiving the money, both the partners are entitled to receive that amount. Here the students are often getting confused that why dies and why will get the sum assured. It is not so, because the premium is paid by the company, by the firm, business. So the business will receive the amount. Whatever the amount is received by the business, all the partners have got the rights according to their profit sharing ratio. Let us assume here they have got the equal rights. So the profit sharing ratio is equal, then both of them will get the amount. So, let me make you clear by another example if you don't still understand. Suppose I have taken a car insurance. Who is paying the premium for that? I will be paying the premium year after year. And after some time the car meets with an accident and gets smashed. Now the insurance company is making the payment. Who will receive the payment, the car or myself? Of course myself. Like that, when the premium is paid by the firm, business, the business will receive the money. Whatever the business receives, all the partners will have the rights to receive that amount according to their profit sharing ratio. Here Y dies, and they have, let us assume that they have taken a policy, joint policy of 50 lakh. Now what happens? The premium is paid by the firm. So on the event of death of Y, the company will receive 50 lakh. What is the journal entry? Bank or cash account, debit. Let me take it as bank account here. Debit 50 lakh to JLP, joint life policy. 50 lakh. Now this joint life policy will be distributed to the partners, assuming that their profit sharing ratio is equal. X will get, X's capital account will get 25 lakh and Y will get 25 lakh. Now what happens in the balance sheet? Now see here, in the balance sheet, Y has to make payment. Now what this X will do in the balance sheet? X's capital is increased by 25 lakh. Increased by 25 lakh. Now the machinery is there for 50 lakh. What he will do? Whatever the amount he received in the bank, 50 lakh from insurance company, he will make this payment to Y. Because Y has to receive 25 lakh rupees as capital and 25 as JLP. So he will make the payment of 50 lakh whatever received from the insurance company, and he will be the sole owner, because this Y's capital will become X capital now because he has paid him. So this will be 50 lakh and he will become the sole proprietor of this business. He need not to sell his machinery or close down his business. That is why always life policy is taken in partnership. There is one more policy which is known as joint and several. See here, suppose there are 3 partners and let me take it as A, B, C. The firm is again taking the policy in their individual name, separate, for one policy for A, one policy for B and one policy for C. This is known as joint and several. These type of policies are known as joint and several. But here also the premium is paid by the firm only. In both the cases, in joint policy, see here, in joint policy, what happened? The policy is one in both their names and it is known as joint life policy, and premium is paid by the firm. So whatever the money received from the insurance company by the firm will be distributed among the partners in their profit sharing ratio. Here also the policy is taken separate. It is known as joint and several, and the premium is again paid by the firm only. In both the cases, the premium is paid by the firm, and who pays the premium will receive the amount from insurance company. Make it very clear. So the money received from insurance company by the firm will be distributed among the partners in their profit sharing ratio. Now what about the accounting treatment of JLP? JLP is treated in three ways. One as an expense, and as an asset, and as a reserve. We will see in our next video the accounting treatment of JLP as an expense, as an asset, and a reserve. Thank you for watching. Please don't forget to share, comment, like, share and comment with your friends. Please share this video. If you like this video, give a thumbs up, and thank you for watching.